All right, David, so good to see you, and wonderful to see you again here in Austin. So we're back at the Dimensional Headquarters Austin studio, and we're recording a session with David Booth, who is the founder and executive chairman of Dimensional Fund Advisors. He began the business in 1981, but he has an illustrious background that we'll delve into. So great to see you, David, and having you here in this session.
Well, thanks so much for coming over. It's a long way, and I enjoyed seeing you this spring in Singapore.
Right.
So.
So maybe a little bit trip down memory lane and some history for our audience because obviously, David founded Dimensional in 1981 in your New York apartment.
Yeah.
But there's a long, illustrious career that led to that point. And I think a lot of people don't realize that you actually also worked at Wells Fargo,
Right.
which later became Barclays Global Investors, which was taken over by BlackRock.
Yeah.
So, BlackRock and all the passive index investing stuff that people talk about, you were there at the genesis, like the beginning of all of that. Jack Bogle came to you guys and your team, you, Mac, and the team, to learn about index investing from you guys, right?
Right.
So there's a lot of history behind this, and maybe just go back memory lane and walk us through that history and how exciting it was back then. Like a lot of things that we take for granted now were like innovative stuff back then, right?
Oh yeah. Right. No, well, just background. I was in business school in the late '60s, and
Yeah.
I was working with Gene Fama,
Yes.
So by 19, so let's just focus on what life may have been like in 1971. Picture this. So by that time, we had a lot of evidence that people aren't going to be able to outguess the market. You
Right.
can't predict the markets.
Right.
And you can have a great experience without doing any of that. You want to plan for what can happen rather than predict what you think will happen. It's kind of a bit of the mantra. So
Yeah.
people go, well, okay, if you can't outguess the market, what are you supposed to do?
Right. This is the random walk
Yeah.
stuff, right?
Yeah.
That used to be, yeah.
Yeah. And so the consensus was, well, on the equity side, you want to hold a diversified portfolio. Let's say the New York Stock Exchange had 2,000 stocks in it at the time, roughly.
Right.
Why not hold all of them?
Yeah.
Okay. And just don't trade, low cost.
Mm.
And that was kind of that's about as far as the academics got. Well,
Yeah.
it turns out that at Wells Fargo, Mac McCown, who ran the management sciences department at the bank, had hired Fisher Black and Myron Scholes
Wow.
as consultants. And so they persuaded him that, look, what we need to do is engineer portfolios that can have a higher expected return than the market. And they came up with two ideas. One was leverage. So I worked on the project. We were going to come out with a levered S&P 500 fund. And the way that would work would be for every $100 of client money we got in, we would borrow 45 and invest $145 in the S&P 500.
Right.
Well, had that gotten off the ground, we probably would have said back indexing 10 years. I mean, because we would have started right before the 73, 74 market downturn. So that was it. A lot of these ideas look silly, but at the time, you can see the concept was everybody's promising to beat the market. So you got to somehow, we thought you had to promise to beat the market. The other idea they came up with was an equal weighted
That's
strategy.
quite popular for a while.
And Samsonite, their pension fund, they said, oh, we'd like that idea. Why don't we try that?
Oh, really?
Okay, so that went live. So structure is the first thing. Okay, what are you supposed to do? The first thing is develop a structure. Well, we have this structure. I can assure you an equal weighted index idea is a crazy idea because you'd be trading all the time every day.
Yeah.
'Cause every day, the equal
Huge
weight,
cost,
they don't move.
huge turnover.
Yeah, it'd be crazy.
Yeah.
So, but anyway, that's the second part of it was how do you implement it? If you don't think you have special insights about a stock, and you go to the marketplace to trade, and you're largely trading against people that think they know something, and they're trying to sell you something. Why won't you get crushed? Why won't you get bagged? How do you prevent yourself from getting bagged? Well, here's a kind of a sidebar story there. At the same time, Fisher Black and Myron Scholes, at the same time Fisher and Myron were persuading Wells Fargo to do indexing, they were also developing the Black-Scholes option pricing model. Basically the same time. I mean, these are heady days. You know, new research all the time, and Black-Scholes, and we didn't use the option pricing for running the portfolio, but the implication of Black-Scholes option pricing model we did use. The major implication of option pricing is flexibility has economic value. That's well documented, and we can measure it. So Myron and Fisher correctly then said, look, we'll use as much flexibility as we can. I don't know if this is because they just developed the option pricing model. We're going to, in terms of trading, and they came up with kind of an elegant way of trading that worked very well. Okay. Fast forward then 10 years to dimensional. Creating, at that time, our initial clients for years were just big institutional clients. And in 1981, big institutions weren't investing in stocks of smaller companies in any meaningful way. So we came out with a small cap fund.
No one had even used the word small cap much,
they didn't use the word small cap. And in fact, there was confusion about that. They go, people go, well, sometimes you can have a small cap and be a relatively large company. If you do a poor job of running your firm, you can be, anyway, those are side issues. But the principle was you ought to have large and small stocks. You shouldn't have all your money in
the diversification benefits,
diversification benefit. And historically, small stocks have higher average returns. So here again, kind of memory from 10 years earlier, how can we engineer a portfolio that has a positive expected premium over the S&P 500? Small cap. So that was, and secondly, when at that time there weren't any small cap indices. So this is, but quickly small cap indices became available once we got started. And the trouble with a small cap index is, let's say they update the index once a quarter, the index fund managers have to blow out everything that, and we go, that doesn't make any sense. Your trading would be too much. You want low trading. So what we did some research and found that the best way to deal with that was to have our small cap benchmark, and then, but we wouldn't sell a stock just when it crossed the boundary. We would wait till it got to be 50% bigger than the biggest company we were then buying. And by doing that, we reduced turnover and eliminated the problem of index funds of having high turnover. So that's number one, the structure. Parallel here again, drawing back on Myron and Fisher and the work we did. I worked on it too, but at Wells. The second part then is execution. People said, how do you know you're not going to get bagged in trading? We said, well, look, trading is a skill. We think, even though we believe in markets and how they work, and a good trader, we believe that a good trader can do a better job than a bad trader. If you just go to the market and put in a market, buy me the stock market, or worst case, it's even worse for index funds. They go, I got to have market on close. What that means is, an index fund, if a new stock comes into an index, an index fund manager has to go to announce to the marketplace, I will pay anything, but I have to have you guarantee me today's closing price. And if you do that, if I buy it at the closing price, that's the price that goes into the index value that day, then I'll have zero tracking error. So I win.
but the client loses.
But the client
oftentimes,
loses.
yeah, when
Because
you're
what you've
investing.
done then is just
Yeah.
transfer the trading cost into the index.
Yeah.
And so, the index is flawed at
Yeah.
that point.
Gerard used a great example of Tesla going into S&P 500 recently as a prime example of that,
Yeah,
right? Where
right.
it cost a lot. Yeah.
Right.
Yeah, more than the annual management fee of a passive index fund.
Yeah, right.
Oftentimes. Yeah, it's crazy.
So
Yeah.
I guess even though we have this powerful belief
Mm-hmm.
in markets and they, that you can call it efficient markets, but just the idea that markets do a pretty good job of pricing. Even sometimes people think that then there's nothing you can do to add value. There's plenty you can do to value. You just don't have magic.
Yeah.
But there's a lot, if you understand market mechanisms and how they work, there are any number of ways you can improve on performance, taking advantage of flexibility.
Right.
Going back to Black-Scholes option.
Yep.
So, our initial clients, they were very worried about us getting that. We thought we wouldn't be able to match the performance of a small cap index
Yeah.
because of trading costs. You get, and so that's an empirical question.
Yeah.
How do you know?
Yeah.
You don't know unless you try. So
That's right.
people gave us small amounts of money to begin with to see if we could do it. And it turns out not only do we not underperform in indices, we took what was a problem, trading, and turned it into an opportunity.
Yeah.
So we used our flexibility to go into the marketplace and trading. The people on the other side are largely inflexible. An institutional investor, if they want to get out, they don't want to get out a week from now or a month from now. They want to get out today if they can. So they have anxiety,
Yeah.
and if we can figure out how to, take advantage of that. I mean, it's not like we're doing something wrong. They're asking, we would like to have a service provided to me. I want some immediacy.
Right.
And so we provide that service for a bit of a
do it
discount.
well. Yeah, absolutely. I think it's going back to what I said earlier. I think it's a lot of things we take for granted now, but when small cap wasn't even a thing, you began that. There's this famous history of Jack Bogle trying to sell his passive index fund with, was it Wellington and Vanguard starting off, and no one wanted it.
Yeah, right.
So we take a lot of things for granted, but I think maybe we shift a little bit towards the factors, the where the name came from, dimensions of investing, and you work directly as a research assistant for Eugene Farmer,
Right.
and we mentioned a lot of these famous economists and Nobel laureates who are the giants of financial economics, and Dimensional worked with them before they received any of these Nobel Prizes,
Right.
which is the most phenomenal thing.
Yeah.
But maybe going back to that and the origins of what does factors and dimensionals, the proven factors of return, mean for investors, and I think also people don't realize that dimensional actually started with small and then took on additional dimensions and factors like value, like quality, and the momentum, etc. Maybe share the journey of how you transferred that academic kind of research into real world implementation in portfolios at Dimensional.
Let me just at this point say that my view of the investment business, whether you're talking about what we do or what you do or what your advisors do, is half technical, half research, all this stuff that we are talking about here today. And the other half is client communication.
Absolutely.
You've got to meet clients where they are in terms of communication. Yeah. So we're out there testing, the idea of small cap. So we get started, and we went around to people and say, look, we want to start a small cap index fund.
Yeah.
And in 1981, people weren't so sure of indexing, and so between like my third and fourth call, I got to come up with a better word than indexing. So, and based on the research, it seems sensible that small stocks behave quite differently than big stocks of big companies. Think of that as being a different dimension. Yeah. So, on the spot, I said we're going to start a small company dimensional fund, and people went, "Ooh, that is so cool."
It is a cool name.
It is a cool name. Yeah.
It stayed cool. Yeah.
And I still
So
prefer it to
relevant.
factor investing,
Yeah.
but what we'd done was actually created the first factor
Yes.
fund, factor-based fund. I still call it Dimension, but
Yeah.
that that's how it happened. I'm glad we're having this chat because
Yeah.
it gives me opportunity to tell people this stuff wasn't all known in advance. You know, here in '71 with that first index portfolio, or now in '81 starting Dimensional, it's kind of like the Wild West. You know, we're
Yeah.
pulling, we're doing the sensible ideas, but you're blazing the trail.
Yeah.
You know, people haven't been there before,
No.
and so that then you asked about that became institutionalized in 1992 with the development of the Fama French three-factor model. So that really comes about because of two parts. First was Bob Merton, our resident scientist, had developed this multi-factor theory
Yep.
in like 1971. So this was going on too. And but it had never really been, there was never an empirical model to support that. So that's really what Fama and French did. And with a paper, they started in '91, was published in '92, that showed this, instead of a single factor, the beta model,
Yeah.
there's a three-factor model. You need a size variable and a value variable. I got the first draft of that paper in September of '91. And I was talking to a client on the phone, and this client said, I said, "What are you working on?" He goes, "Well, looking on this value and research. Do you know anything about that?" I said, "Funny.
I was just looking at that.
You should, I just got this paper. Let me come talk to you about it."
Yeah.
So I went to talk to him. He lived in Atlanta. I said, I tried to explain it. I wasn't doing a very good job. And so I said, "Do you ever get to Chicago?" He goes, "Yeah, I'm going there next week or next month." I said, "I'll meet you there." So
Fantastic.
I met him in Chicago. We went down to Fama's office
Nice.
on campus and had him explain this multi-factor
Yep.
research. And it's like Fama's sitting here with his back to us, his bald spot showing, and the client and I are standing behind, and he's, waving his hands and explaining the stuff on the screen. I'm not following it, and so I know he's not
No,
following it. But anyway, I called up the client the next week. He said, "So what do you think about that? Based on that research, we'd create a value strategy, a large cap value and a small cap value."
Yep.
I said, I'd like to do that." So that was, we got him
Was he an
going.
anchor investor for that?
Yeah,
Huh?
got it going within like 6 months. So
Wow.
like February or
Oh, that's
February, March
amazing.
of
Yeah.
92. The paper got published in August of '92. So we were up and running before the paper was
Paper
published.
came out officially.
That's about as cool as it gets.
That is so cool. Yeah, fantastic. So I'm going to use a couple of your quotes because I love some of the quotes that you've shared. And a lot of people use Warren Buffett or Jack Bogle, but I love your quotes. And one is, trust the market, not time it.
Yeah.
And the other one is, you have to be smarter than the market to beat the market.
Right.
And it turns out that actually most of us are not smarter than the market, right? So, one of the key concepts to both of that is, the market return, right? And then also timing. And there is a time frame within which you can harvest the proven scientific kind of evidence-based way of investing that Dimensional, proposes to investors. So maybe you can share some of that thoughts about, the markets and timing, which a lot of investors do very badly. And oftentimes they sell at the bottom of the market cycle. I heard of like many investors last year in 2022 just finally succumbed at the bottom, and look at how markets have done this year. So timing is so important, but especially when it comes to Dimensional, because there are periods when value may underperform, small may underperform, quality may underperform, but it's actually the persistence of those returns over long periods of time that allows us to harvest those returns, right?
Yeah, right. It's It's generally accepted that stocks have a higher expected return than investing in money market instruments.
Yeah.
And is borne up by evidence over time. The trouble is it usually takes 20 or 30, maybe 40 years to conclude with enough
Solid
statistically
evidence,
that that's true.
Yeah.
So most people don't want to sit around and wait 20 or 30 years to prove that stocks have higher average returns. You're going to have to, at some level, you're going to have to do things that you think are sensible.
Yeah.
So we have all this great research, and just like in health, for example, you know, there's a lot of enormous amounts of medical research, but still in a lot of the, you know, the health issues that come up, we don't know the answer for sure. You know, you have some insights from the research, and things are getting better. I mean, we have better medicines and stuff, but we haven't cured a lot of things. And I think that's really what we are talking about with investing. We'll never know the final answer about how markets work, but we've learned much more. You know, we've learned that, you know, looking at the total value of the stock market index, like a Russell 3000, is not exactly what academics think of as a market portfolio. A market portfolio academically includes, you know, stocks, bonds, you know, gold, your house, whatever, my car. You know, that's everything goes into
all your
market.
assets.
So we don't really know what a market portfolio is. So basically, what we've done is use the research of particularly Fama and French, and come up with what we think are sensible market portfolios. We call them core funds. You know, a little bit more in small in value than you see in a published index, for good reason. We think it's sensible that those premia are there, but you know, we've seen them be on the wrong side of that over long periods of time. When we started, our first 9 years, we happened to start at the beginning of the worst 9-year run for small stocks relative to large. That's an ouch. When you don't have a track record and your first 9 years are disappointing, that shows you the power of an idea. How do you even have a business? It's because it was sensible that you would have large and small stocks. You keep going back to first principles all the time. It didn't show up this time period. Based on the variability of returns, it's unusual, but it's not totally surprising.
Yeah. That must be in a painful period.
That's why I wear a jacket now, because of all the scars on my back, you know, getting flogged, you know, so.
But that's important because I think more than anybody else, I think, David, you really understand the pain points of when these factors underperform, and you empathize really well with investors. But there's a huge learning from your experience because you have to stick it out.
Right.
And that's how the small cap fund itself, which underperformed the first 9 years, has over decades outperformed.
Right.
It's phenomenal. Yeah. Despite that.
Despite that. We often say we don't have clients with investment problems. We've got investments with client problems. You know, if we can just unlock that, people's intuition is gets them intuition probably saves you in life, but not when it comes to investing.
Investing, you know? It should be scientific and evidence-based,
right.
And so that comes to a very important point, and this is what separates Dimensional again from the crowd, is your choice to not just do institutional, but also not go direct to retail, but go through an advisor, a trusted fiduciary that works with the client to really help them understand, how Dimensional invests and allows them to stay the course. So how important is that, and the role of the trusted advisor like Endowus in this business?
Yeah, the only thing more difficult than acquiring clients is keeping them. And people, it takes a long time frequently for people to really absorb what's going on here.
Right.
And we don't want, instead of say product push, we're more of a demand pull. We explain to people why we're doing what we do.
Yep.
we were unique at the beginning, still somewhat that way. In that we require people to come in to our offices at their expense for a couple of days to learn why we do what we do. I mean, that's
Yeah.
and the reason we do that is I love getting clients, but the pain of losing clients is much greater than the thrill of gaining clients. So we want to make sure people understand what's going on, and if we do that, people are more likely to stay with you. One of the principles of investing we really feel strongly is you got to have something that you can stick with.
Yeah.
You know, getting whipsawed in and out over the long haul, that has a negative expected outcome.
Yeah.
You know.
Yeah, here's another great quote from you. You've already paid for the risk, so you might as well stick around for the return, right?
Right.
And that's what, I mean, a lot of clients exit at the wrong time.
Yeah, let me explain that a little bit because I have a rough time explaining that one. Suppose the market drops today.
Yep.
Well, I mean, world economic conditions haven't changed in one day that much. But why has it dropped? It's dropping so that you have a higher expected return going forward. You know, you can't have a negative expected return in the market. Market doesn't work that way.
Yeah.
You know, that's the beauty of markets. It's setting prices every day so that you have a positive expected outcome. Sometimes the market gets it wrong. You know, markets aren't perfect.
Yeah.
But whereas you go back to healthcare, there's nothing out there that's trying to make, I mean, your body kind of corrects a little bit.
Yeah.
You know, it's this self-correcting mechanism of the market that's really great to watch.
Right.
You know what it is? At the end of the day, it boils down to human ingenuity. You know, we don't know. We did a lot of this in March of 2020, right when the pandemic hit, and people were really stressed out. The markets around the world were down. I go, look, we can't predict what's going to happen. COVID just hit. No, what we can assure you of is that people don't just sit there and take it. When something bad happens, they try to figure out how to get back on track.
Yeah.
We do that as individuals. We do it as companies. I don't know which companies are going to do it, but I have total faith in our system that all these companies are working for us, they're going to try to do the best they can.
Yeah.
And some will win and some will lose. That's economics. But this is no time to bail out.
Yeah. Ingenuity of humanity.
Right.
Yeah. Comes through every time there is a crisis. And I think that, you know, people talk about like psychology of investors, the behavioral aspect of investing, and this is where I think trusted advisors like ourselves and Dimensional's investment process really helps. So, you know, it's fantastic that you've built the studio to develop great content. What is the role of education, do you think, in, you know, interacting with these clients and helping them make the right choices over time?
It's paramount. And what I find with our clients is they just can't get enough. If you keep going down that path,
Right.
they learn a little bit more every year. And you know, at the end of the day, I think what people want to do, I mean, yeah, they're interested in financial security, and we can engineer good solutions for them and execute. And we can do all of that. But if education, if people understand where you're going, I think they're more likely to feel safe.
Yeah.
And I think that's one of the feelings that in terms of behavioral, what you're trying to do as an advisor with your clients is let them know, look, we'll do the best we can. We'll give you some of the best ideas, but nobody's model is perfect. And so, but if you understand why we're doing what we're doing, then I think you'll think that it's sensible, and over the long haul, you'll be pretty safe.
Right. Fantastic. And Dimensional is now, you know, we talked about where it came from, but now it's a 800 billion AUM, massive fund management company, and the leader in systematic and evidence-based kind of investing. Where do you see the future of Dimensional? And, you know, in Asia, we're very new to this thing, right?
Right.
Even index investing, passive investing, Dimensional is relatively, you know, unknown in Asia.
Sure.
We're trying to change that.
Right.
But, you know, what are some of the advice that you would give to investors who are starting off on this journey?
I think there are three. Let's take three possibilities. We'll reject the first one. The first one is we'll have all kinds of brilliant new investment strategies, and we might have,
They come and go. Yeah.
but they're not. I don't think that's the future. There are really two parts to it.
Mm-hmm.
One is increased personalization. We're doing more and more work with smaller, separately managed accounts.
Right, right.
I think that's one way to go. And also engineering solutions, as we tell people, in my view, uncertainty is kind of the unifying theme across life. I mean,
Yeah.
it's uncertainty about markets, uncertainty about health, uncertainty about raising the family, uncertainty about what car to drive,
Yeah.
So it's uncertainty. That's what all of this, and integrating what we're doing with investing. Frequently the term is called holistic wealth management now.
That's right.
We have a term called LIFE, for lifetime integrated financial experience. I think that's, so integrating investing with every other part of life is part of it. And the other part is just improved communication. I'm just so working on, the last 10 years I've worked really hard on trying to unlock that key to unlock that lock
Yeah.
to people in terms of communication, to have them have that aha moment. Now I finally get what you guys are talking about and how markets work. That's so exciting to work on that.
That's fantastic. One of the words that Dimensional is associated with very closely is innovation. And these days, a lot of people talk about AI. In Asia, a lot of these robo-advisors kind of sprouted up, and we don't call ourselves a robo-advisor because we hate that word. I mean, there's no robo and there's no advice.
Right.
It's like a quant model that is really bad and leads to bad outcomes. But these fads come and go. Technology, everybody's trying to use technology to beat the market. What are your thoughts on innovation? And I'm really excited because Dimensional isn't a stale organization that just does small or value, but there's a lot of spirit of innovation. There's a lot of research going on. You have deep connections with academia, and you're really innovating the space of financial investing. And so maybe if you could share a little bit about your thoughts on innovation in this field and how Dimensional is positioned in that.
Well, a lot of the innovation will come because of technology improvements. The operation costs of running a portfolio continue to plummet.
Yeah.
And with that, you can do more things. You can be more innovative. So that's one aspect of it. I will comment on AI, which is AI is one aspect of AI is taking enormous amounts of information from all sources and coming up with solutions. Well, that's what we believe markets
been
do.
doing. Yeah.
That's the stock market is the best AI algorithm around. All the information, we believe all that comes together in market prices. So as a result, I don't think AI is going to be particularly useful in outguessing the market. AI is the result of the market interaction.
Market and the information that it provides. Yeah.
So
it's funny because ChatGPT said that we don't actually do anything on financial markets because they know that it's pretty impossible, right? And the market is the best AI mechanism because you have guys using supercomputers who are participants in the market that provide that information and feed it into the market as well, right? Yeah.
You can impact the market. If I put an order for 1 million shares of a small cap stock, that's going to move. You can change everything. So it's the other thing is AI. Even you have to be careful with AI. Not only can you not use it to predict markets, it's very difficult to use it to predict how you'll react to what markets do.
Yeah.
I mean, we can all say, oh yeah, if the market does this, this is how I'll react. And you don't know until it happens.
Right. Well, David, I mean, the one thing that I always felt when we met in Singapore a couple of times now, a few times, and here in Austin as well, is how you're so genuine and sincere every time we've met, and the core values that you hold dear, and that's pervasive in everything that Dimensional does. And I think as the founder and the leader, you've really built the amazing culture that Dimensional has. So we really thank you for doing that and helping us to be a partner in Asia, to grow the business as well. So thank you, David, for your time. It was a real pleasure. Thank you for hosting us here in this wonderful studio, investing into the infrastructure and the content that we also use a lot for our clients, and for this time, generous time that you've provided.
Well, thank you so much for being here. Yeah.
Thank you.